Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today with our weekly wrap-up. Graham, can you tell us what's been going on in the market?
Yeah, thank you, Stacy, and thanks for our viewers of being on the call. Yeah, we had a shortened holiday week last week. Really saw the U.S. equity indexes fall a bit. The likelihood of maybe a recession was heightened as we saw the service demand really weaken, and we saw labor markets really weaken. So we saw the Russell 2000, that small cap index, continue its slide off about 2.5%. NASDAQ, which holds large weightings in technology, off about 1+%. The S&P was down fractionally. If we look at what was the best performer, it was a bit mixed. But one sector rose about 3+%, and that was more of the defensive sectors like utilities and healthcare. What did we see fall the most? It was really consumer discretionary, off about 3+%. One area of the market really gapped up about 6+% higher, and that was crude oil, off of OPEC announcing a surprise production cut of about 1 million barrels per day starting next month. Gold continued to see, getting a bid. It was up a couple percent last week. That's been a consistent theme. And it's just 3% below an all-time high that it put in August 2020. Jobless openings fell to the lowest levels since May of 21, and initial jobless claims also jumped 228,000. Now, that generally is a negative, but it's a positive, hopefully bring inflation down and maybe allows the Fed to take their foot off the gas pedal as we start to see the economy slow. Not fall off a cliff, but slow, right? Average hourly earnings growth slowed slightly to about 4.2% year over year, but it was still a bit above the Fed's comfort level. If we think about our friends overseas, internationally, Australia became the second major bank after Canada paused their rate hikes. We're still seeing reasonably good growth over in Germany. Manufacturing sector continued to rebound. If we look at China, the manufacturing activity did stall in March, but their services surged to the highest levels that we've seen since November of 2020.
Okay. Well, Graham, I understand that earnings season is upon us. And so with that in mind, how do you think the markets are going to do?
Well, Stacey, that's $1 million question, but hopefully they'll be tempered in their enthusiasm. Hopefully they'll be tempered in their negative approach if earnings don't come in as well as we hope they do, right? We want earnings to pause, and we're expecting earnings to pause a bit. Some sectors are going to be hit a bit worse than others. We still want them to fall off the cliff, right? So I think banks are going to be kicking off earnings the latter part of this week. We have some inflation numbers coming out this week. So we got a lot going on this week that the market's going to have to digest and see what direction it wants to move in.
Okay, well, I guess we'll see how all that turns out when the dust settles. Thank you so much, Graham, and thank you to our viewers for joining us this afternoon. I do want to put a quick bug in your ear. We have scheduled our Retirement Planning Today classes for the month of May. So if you are interested in learning the A to Z about the retirement planning process, take a look at our website and you can check out those dates and learn more details. We'd love to see you in class. And just have a great week. We look forward to seeing you again next Monday for the weekly wrap-up. Thanks a lot and take care.
Take care.